one of the big themes, really, for the past couple of years, has been geopolitics. So Joshua Barker from RiverX has brought us 3 stocks for a dangerous world. Hi, welcome. So when you're considering stocks at RiverX, are you always considering the macro?
Yeah, I think so, because we are asset class agnostic, so we can switch between the different asset classes, whether that be across fixed income or those assets are a premium to the RBA cash rate, stocks, commercial property, infrastructure, even private equity. So we can be a little bit more tactical in our allocation. So if we think that the macro environment, particularly rising interest rates or anything like that, maybe an economic recession, we don't have to be exposed to that ASX. We're not looking to mimic the market or even track it or even benchmark ourselves against it. It's more about an absolute performance perspective.
Okay, interesting. When you're thinking about geopolitics, I mean, that is as macro, I suppose, as you can get, really. But there are ways, in your view, then, that you would be able to stock pick basically off the back of that macro.
Yeah, there's always going to be areas of the market that do well. And in particular, not only the macro environment or the geopolitical tensions, but where the money flow and where the spending is coming off the back of that. Like government spending is significant numbers, and it can really drive some of the sectors that are due to benefit from those.
All right, so if, say, and we all hope that there will be, some sort of a resolution to the Ukraine conflict for some reason, would that fundamentally, instantaneously change your view on these stocks?
No, not necessarily, because a lot of the mandates that have come out have been from governments, US, Europe, pretty much every country around the world. A lot of them have mandated to spend a certain amount of capital on these defence sectors. Whether the escalations are still there or whether they're not, they've still made the decision now to spend that money over the next 2, 5, 10 plus years.
Yeah, and do these stocks, would they pass a quality filter? I mean, even if they are winning these contracts now, presumably you'd want to know that they had some diversification. Well, maybe we're just getting ahead of ourselves, because maybe we can talk about these stocks in particular. The first one is Drone Shield. So when did Drone Shield first come on your radar?
Well, look, this one's one that's been speculated by the market for a long time. It's been incredibly volatile. I think for us, it's really starting to get into that investment grade space. And what I mean by that is the revenues catching up to the market cap. There's been times where there's been a real mismatch there, particularly when the stock price has been quite high. It's also flicking over to being profitable, barring a little bit of spending on those growth plays, which they could easily just adjust and be very cash profitable. The other thing as well, they're getting a very significant growth in their software as a service side of their business. So that's sort of up about 200%. So it's becoming more of a reoccurring revenues for them, and it's becoming a business where the fundamentals are starting to match the share price.
Yeah, and I just was reading that, we've got the rearmament of Europe. It's a large market for the company. I think it is the largest market. But again, are those contracts that it's winning sort of diversified across geographies?
Yes, exactly. So they're expanding through Asia at the moment. They're actually supplying to the US, which is mandated to spend $1 trillion on defence, with drones and drone protection being a big part of that. There's obviously the exposure through Europe, that they're more so getting the contracts from other countries that are supplying to areas like the Ukraine. So it's the other countries that are paying for that in their defence aid of Ukraine. But then Trump has also come out, or the US I should say, has come out. They're one and the same these days. His Twitter is I guess, US gospel. But he's come out and said that Europe needs to be more sustainable on its own for its defence policy. So they've come out and really ramped up their spending. Relying less on the US, so they're going to spend capital in that area as well.
Got it. All right, so that's Drone Shield. Austal is another one of your stocks for a dangerous world. I noted that this actually has some M&A on the table as well, an offer from South Korea's Hanwha Group. when you were looking at stocks at RiverX, just to start, do you take possible M&A into consideration?
You never want it to be the sole thesis, that's for sure, because it can be a dangerous game. But I think when you've got the underpinning of a really good quality company and a good quality story there, then that can just provide a little bit more positive sentiment around the stock in particular. So yeah, there's the talks of takeover. There's the talks of they have large shipbuilding manufacturing plants in the US. There's a lot of talks about the US really scaling up that exposure for themselves there, because Asia is obviously a really dominant player in the ships and submarine space.
Yeah.
So they're looking to bolster up theirs essentially. And it's one that has a lot of contracts. A lot of these businesses in the defence space, they operate on a contract basis. So there's a lot of certainty in the revenues. For example, Austral has about 14 billion in contracts lined up. Last year they did 1.5 billion in revenues. It's a $2 billion market cap. So they've got a lot of certainties. It's obviously deliverable over a long time. It takes a long time to build a ship, believe it or not. So, these tariffs and things like that are probably not going to have much of an impact, because it's going to take 5+ years to build a lot of these ships. So by the time it moves, we're probably not going to be talking about tariffs next term.
Yeah, and you've
hopefully.
got to, well, let's hope not, but you've got to sort of think as well that the US has a lot of impetus to start building ships quicker. I think China can spit them out, at an exorbitant rate. But also, I think that it's important to point out that Austral builds its ships in Alabama, so it's domiciled in the US.
Yeah. Even locally, the Australian shipbuilding and submarine building sector is going to levels that we haven't seen since World War II. So we're actually building locally here as well.
Now, I did note, though, that share price has already run. So, how do you think of that? Like, when do you start to take profits in a company like Austral?
I think at the moment it's still definitely a positive outlook for the company. Like I said, with those contracts, it's just further contracts coming through really just continues to bolster that. We've seen a similar thesis with companies like Pro Medicus, where it's locking in those contracts, it's getting new contracts, and the share price just continues to go higher. So I think as long as the company's doing the right things, then continue to hold. The market cap's 2 billion. They've got that outlook.
So you're happy to let stocks run at RiverX?
Yes, certainly. As long as the company is going to continue to make those strong returns and those risk-adjusted returns from these levels, which there's no signs to point that Austral wouldn't. So yeah, happy to hold.
All right. So Drone Shield and Austral are the companies that come to my mind when I think defense. What's the third for a dangerous world? Yeah,
so EOS or electro-optic systems, a little bit more on the speculative side, but they really are getting into the nuts and bolts of supplying for defence. Historically, they've been a little bit more in the satellite area, protection area, but now they've shifted more into the defence, which is actually making them a little bit more of a sustainable business as well. Their revenues have grown for the last few years, and the earnings are becoming less and less cash burning. Hasn't quite switched to profitability yet, so I would flag that this is probably more of the speculative end of the three stocks. Probably moving into maybe a watch list as you start to see it move into that investment grade thesis like I spoke about with Drone Shield, but definitely a really quality company to keep an eye on your watch list. It's also benefiting from supplying things like tanks and remote firing things in the Ukraine, again paid for by other countries.
Yeah, it has got a contract which the buyer is believed to be a NATO member supporting Ukraine. So this is kind of, from what I've read, a turnaround story. So you're not reticent when it comes to turnaround stories? No,
look, I think it's quite constructive on the charts as well. It's pretty much at 52-week highs, but it has had a history of about 5 or 6, 7 years ago of being a lot higher. So it's one that the trend is definitely with you. Like if you see a lot of people talk about stocks and how good they are, but if the share price is not supportive of that, and if it's continuing to be in a downtrend or on 52-week lows, the chances are that someone's missing something. So you definitely want to work with the trend, and I think the sooner investors can learn to do that and potentially cut their losses short, the better off they'll be. Everyone gets it wrong. There's no sort of stigma around that. The best fund managers, like your Magellans and your Regals, have been the best fund managers for a period of years, and then still had those in hindsight what seemed like wrong decisions. So don't be too tied to some theses. Be prepared to cut your losses if you're looking at a stock that's just continuing to bleed you dry, essentially.
Yeah, well, that's what my last question was going to be, because as we've learned, things can change very quickly.
Yep.
So you at RiverX are quite active constantly?
Yeah, I think the big thing for us is the opportunity cost. When you've got access to investments and the investment world, whether that's just the market or you've got access to the entire fund management landscape, there's a lot of options out there. So there's no need to sit there in a stock that's going to underperform for a year or two. And if you don't believe that it's going to make you that 20% per annum every year, then it's probably something you don't want to be involved in. And if you've got the option and the opportunity cost and looking at it from a risk to reward point of view, if you've got the ability to go somewhere else where you can get a much more certain return of 10 to 20%, depending on what it is, then don't be afraid to cut those losses or take those profits, and look for the opportunity cost, and just look at it a little bit more on a numbers basis of where you can achieve the best returns that year.